Hello to everyone. Today I am going to introduce Financial Risk Management Part 2. If you are interested to have more videos on banking and finance related topics, please do subscribe my channel. Financial risk, the result of a firm's financial market activity. An example of financial risk is interest rate movement after the issuance of floating rates. In this case, the issuing firm will be negatively impacted if the market rate increases. Basically, the central bank of any country deals with the interest rate. So, in order to monitor or in order to supervise certain measures, the central bank take the decision for the change of interest rate. On one side, central bank need to increase the circulation of money within the country. On the other side, the consumers have sometimes negative effect with the change in the interest rates. Two factors lead to increase the sensitivity to the economic and the financial variable. First of all, deregulation in the banks lead to increase the interest rate sensitivity. And secondly, globalization lead firms doing business out their respective domestic borders, causing these firms to have more exposure to the currency changes. Particularly in case of a developing country, they have great impact of devaluation of their domestic currencies. Financial institutions serve as intermediary for managing financial risk. Great market, instrument to share and hedge risk. Provide risk advisory services. Institution must excel at measuring and pricing the financial risk. So it's purely based on their future forecasting. Now here we are going to explain the difference between the derivative and the security. Derivatives can be used in the financial risk, managed to efficiently hedge and/or manage the financial risk. How? By purchasing the commodities or foreign currencies in future dates. Securities are issued to raise the capital in order to support the project that will earn return greater than the cost of those securities. On one side, you are floating bonds as security to generate your capital debt, and if the return on the project is less than what you are paying to your customer, is one of the major risks. Dual role leverage plays. Derivatives are used as hedging and limited cash outlay. Leverage as financial tool. As leverage increases, the variability of the return increases. Now on one side, we take the example of the derivative. You pay a margin. It may be 10%, it may be 20%. In order to hedge the fund. And secondly, it provides you the risk coverage. Because in the future date, you have purchased any type of a currency by paying a small amount of a margin. On the other side, when we explain the leverage, if the leverage is properly utilized, leverage is basically the part of the debt. For example, if you borrow the money in order to add revenue generating asset, it will definitely increase the return on your equity and on your asset pool. Financial risk management, an integrated framework from managing credit risk, market risk, operational risk, liquidity risk, and economic capital, and transfer and risk transfer in order to minimize firm's value. That all types of the risks we are going to discuss in the upcoming videos. But here, economic capital is the capital that protects the organization even in the adverse position from bankruptcy. Process of detecting, assessing, and managing financial risk. One of the major tools used to manage market, credit, and operational risk is value at risk measure. The risk management process. First of all, you will identify the type of the risk, evaluate the frequency and the severity of the loss, including maximum probable loss that is equal to value at risk, choosing a risk management method, implementation of the chosen method, monitoring the performance and the suitability of the method. If it will not suit, you will re-evaluate and re-choose the risk management method. Value at risk that we have discussed, maximum loss over a defined period of time at a straight level of confidence given normal market conditions. Assume we have gathered 1,000 monthly returns for securities and produce histogram. Compute the monthly value at risk for the security at a confidence level of 95%. At a 95% confidence level, the load tail displays the lowest 5% of underlying distribution return. It means if your confidence level is 95%, so your value at risk is 5%. If your confidence level is 90%, the value at risk is 10%. Now see you again with the upcoming video. Thank you very much.